What if I told you that there's a book that Warren Buffett, arguably the most successful investor of all time, is called the best book on investing ever written? A book so good that he read it at the age of 19 and said it completely changed his life? That book is The Intelligent Investor by Benjamin Graham. And today, we're going to break down every major idea in it. No finance background needed. Let's get into it. Benjamin Graham published this book in 1949, and he wasn't just some academic writing theory from a classroom. He was a professional investor who lived through the Great Depression, one of the most devastating financial crashes in history. So when Graham talks about protecting your money and avoiding catastrophic losses, he earned every word of that advice. The version most people read today also includes updated commentary from financial journalist Jason Zweig, who connects Graham's timeless ideas to modern markets. That combination is what makes this book so powerful. Now, before we get into the meat of it, Graham lays out 3 things he believes every intelligent investor must do: manage risk through smart asset allocation and diversification, maximize your odds through careful valuation and what he calls a margin of safety, and maintain a disciplined approach that stops you from making decisions you'll regret. Keep those 3 things in mind, because everything else in this book builds on them. The first major lesson Graham teaches is the difference between investing and speculating. This sounds simple, but it's probably where most beginners go wrong without even realizing it. Graham defines a true investment as an operation that, after thorough analysis, promises safety of principal, meaning you protect what you put in and get an adequate return. If something doesn't meet all 3 of those criteria, analysis, safety, and adequate return, Graham calls it speculation. Think of the meme stock craze in 2021 with GameStop. People weren't analyzing the business. Nobody was checking whether the company was actually worth what they were paying. They were just hoping someone else would pay more tomorrow. That is a textbook example of speculation. Graham isn't saying speculation is evil. He says if you want to speculate, fine, but keep it no more than 10% of your money in a completely separate account, and never confuse it with actual investing. His exact words: never mingle your speculative and investment operations in the same account, or even in the same part of your thinking. That mental separation is what keeps you people out of serious trouble. The next big idea is one of Graham is particularly famous for, and it connects directly to how you handle market ups and downs. He introduces a character called Mr. Market. Imagine you own a share in a business with a partner named Mr. Market. Every single day, Mr. Market knocks on your door and offers to either buy your share or sell you his, and he names a price. The thing about Mr. Market is that he's wildly emotional. Some days he's euphoric and offers you with a crazy high price. Other days he's terrified and practically gives you his shares away. And here's the key: you never have to trade with him. You can ignore him completely until the price makes sense for you. This is Graham's way of explaining stock market volatility. And when the market dropped 30% in a matter of weeks during the COVID crash of March 2020, that was Mr. Market having a full breakdown, offering great businesses at clearance prices. The investors who stayed calm and bought in, they came out very well. The ones who panicked and sold, they locked in losses and missed the entire recovery. Graham would say that the market isn't your enemy. Your own emotions are. That leads into one of the most important concepts in the whole book: intrinsic value and the margin of safety. Intrinsic value is simply what a business is actually worth based on its earnings, assets, dividends, and long-term prospects, not what the stock ticker says on any given day. The margin of safety is the gap between what something truly is worth and what you're paying for it. Here's how Graham illustrates the math on this. Say you estimate a stock's true value is $50. If you buy it at $40, a 20% discount, and it reaches fair value, you've made a 25% return. But if you buy that same stock at $25, a 50% discount, and it reaches fair value, you've doubled your money. The bigger the safety cushion, the more room you have to be wrong and still come out ahead. And according to Graham, you will be wrong sometimes. Everyone is. The margin of safety is what keeps those mistakes from wiping you out. It's the single most important concept in value investing. Graham literally calls it the secret of sound investment in 3 words: margin of safety. Now, Graham also wants you to understand how inflation fits into all of this. Inflation quietly erodes your purchasing power over time, which means keeping all your money in a savings account or bond isn't as safe as it might feel. One of the advantages of owning stocks in quality company is their earnings and dividends can grow over time in a way that bonds with a fixed payout simply cannot. This is why diversification isn't just about owning different types of stocks. It's also about having the right mix of stocks, bonds, and inflation-protected assets. Zweig's updated commentary mentioned things like REITs and TIPS, Treasury inflation-protected securities. as modern tools for the intelligent investor can guard against inflation eating away at their wealth. Now, here's where Graham makes a really important distinction that affects every decision you'll make as an investor. He separates investors into two types: the defensive investor and the enterprising investor. And right away, he says neither is better than the other. It comes down to how much time and effort you're generally willing to put in. The defensive investor wants solid returns without spending their weekends reading financial reports. For this person, Graham represents a simple, diversified portfolio split between stocks and bonds. Never less than 25% or more than 75% in the other. A standard starting point is 50-50. If the market runs up and your stocks become 60% of your portfolio, you rebalance, sell some stocks, buy more bonds, and get back to 50-50. For the modern defensive investor, low-cost index funds are the best vehicle for this. In fact, both Graham and Warren Buffett have praised index funds as the best choice for individual investors. The strategy sounds almost boring, and that's the point. An investor who automatically puts money into a broad index fund every single month for 30 years will almost certainly outperform the vast majority of professional investors. The only real flaw of index funds, as Graham's commentator Zweig notes, is that they're boring. That's it. Boring is fine. Boring builds wealth. The enterprising investor, on the other hand, is willing to do real work. This person actively analyzes companies, hunts for undervalued stocks, and is comfortable digging through annual reports and financial statements. Graham lays out a specific set of criteria for this approach. Things like a company having at least 5 to 10 years of positive earnings, a strong balance sheet, a history of paying dividends, and a stock price that doesn't exceed 120% of the company's net tangible assets. He also identifies several strategies the enterprising investor can use: buying undervalued bargain stocks, finding larger companies that are currently unpopular or fundamentally strong, and occasionally identifying smaller companies that could be acquisition targets for larger ones. But, and this is critical, Graham is firm that there's no in-between. He says if you're not willing to put in the work required to be an enterprising investor, you should be a defensive investor. Trying to be both usually means you end up being neither, and making costly emotional mistakes along the way. Graham also dedicates a significant section to investment funds, what we broadly call mutual funds and index funds today. His findings are eye-opening for beginners. He points out 5 patterns that tend to hurt investors. The average fund doesn't pick stocks well enough to overcome its own costs. The higher a fund's fees, the lower your returns. The more frequently a fund trades, the less it tends to earn. Highly volatile funds tend to stay volatile, and funds with high past returns are unlikely to keep outperforming. His advice? For the defensive investor, a boring, low-cost index fund is not a consolidation prize. It's the right answer. Be skeptical of any fund promising dramatically above average returns. If you wouldn't stick with a fund through at least 3 rough years, don't buy it in the first place, because patience is a fund investor's most powerful weapon. One topic Graham covers that a lot of beginners overlook is financial advisors. He acknowledges that most investors are novices prone to emotional mistakes, big drawdowns, overpaying in fees, not diversifying properly. A good advisor can protect you from your own worst instincts, especially in a volatile market. But he's clear that not all advice is equal. His warning: much bad advice is given free. If you use an advisor, look for someone with a strong character and a conservative, value-focused approach. And Zweig sets a hard cap of 1% of your assets per year in advisory fees. More than that, and you should probably be shopping around. Graham also recommends having a clear financial plan in place, one that outlines how you earn, save, spend, borrow, and invest. Combined with a written investment policy that spells out your approach and an asset allocation plan showing exactly how your money is divided, that structure keeps emotions out of the driver's seat when markets get rough. So let's pull it all together. The legacy of the intelligent investor isn't a stock-picking formula or a guaranteed path to quick wealth. It's something more fundamental than that. Graham's core message is that your greatest enemy as an investor isn't the market, a bad economy, or even picking the wrong stock. It's you. Your fear when prices drop, your greed when prices spike, your tendency to follow the crowd right into a bubble and run from the exit right into a crash. Every concept in this book, the margin of safety, Mr. Market, the defensive versus enterprising investor, the separation of investing and speculation, all of it is designed to build a framework that keeps your emotions from destroying your financial future. As Graham puts it himself, investing doesn't require a genius IQ or special inside information. What it requires is a sound framework for making decisions and the discipline to keep your emotions from tearing that framework apart. That's it. The strategies are simple. The discipline is the hard part. If you take away one thing from this video, let it be this. Start thinking like a business owner, not a gambler. Buy things for less than they're worth. Be patient. Ignore Mr. Market when he's being irrational, and take advantage of him when he is. The results will follow. If this was helpful, drop a comment below with one idea that hit hardest for you. I'd love to hear it. Thanks for tuning in. Same pace next time. Keep compounding.